Welcome to the first metric of the month. So every month we're going to make a short video diving into one particular metric that can help you grow. We'll cover what it is, why it matters, and how to use it, and that in just a few minutes. So let's dive in. The first one we're going to cover is operating cash flow or operational cash flow. And it's part of total cash flow, but the key difference is that the operating cash flow only includes the cash flow that comes from you normally running your business. So anything that's not operational is not included. So sounds logical, but let's dive in a little bit deeper. Essentially, the operating cash flow is all the operational cash inflow minus all the cash outflow. And the cash inflows are the money that you receive from normal operations. So these are, of course, the payments that you have from your customers or your clients, but also any refunds that you get from suppliers, any advances that you get from factoring companies or deposits that you get from your clients, even VAT that you get back from the tax office. Now, what is not included here are, for example, loans that you take out from a bank, because money that you take out as a loan is not money that you receive from running your business. Money that you as the owner put back into the business is also not operating cash flow. And of course, money that you receive from selling an asset, a website, a sub-brand, or any other bigger thing that you sell that's not your normal business is not operating cash flow. Operating cash outflow is, of course, the money that you pay out that relates to you running the business. So money that you pay to your team, to your suppliers, to your contractors, and all your normal expenses. What's not included in here are irregular expenses. So dividend payments that you pay to yourself, investments into buying a website or a different business, or repaying loans, because those are not related to you running your business. Then next question is, why does it matter? Now, there's a saying, revenue is vanity, profit is sanity, but cash flow is reality. And in the end, it's your operational cash flow that's the metric that shows how healthy your business is. Are you actually generating positive cash flows? If not, your business might be unsustainable. If it's negative over a longer period of time, so not necessarily 1 month or another, especially if you're having inventory that you have to pre-finance, etc., you might have short-term negative operating cash flow, and that's fine. But if it's negative over a longer period of time, you have a big problem. Longer, therefore, depends a bit on your specific business. But as a pretty much general rule of thumb, on a quarterly level, it has to be positive. The reason we look more at operating cash flow rather than total cash flow is that total cash flow includes all of those non-operating items. And therefore they can hide or obscure the actual operating performance. For example, if you have a negative operating cash flow, but you keep drawing money from investors or you keep lending money from banks, and it doesn't matter here if it's debt or equity, but if you keep getting money in that's essentially investment, your total cash flow will be positive, and therefore it kind of hides the operational reality of you losing money. Same would be the case if you, why we look at operating cash flow more than your P&L, especially in the longer term, is if you realize the revenues, but your customers are not paying you, so you're having a lot of revenue on your P&L and you have a lot of accounts receivable on your balance sheet, your cash flow will be negative. So your P&L looks like you're doing well, but your operating cash flow will be very negative. And in the end, you're paying your team, you're paying yourself from the cash flow. So that is why the operating cash flow is arguably the most important metric to look at.